In this presentation, we will discuss restricted assets and investments related to a non-governmental, not-for-profit organization, a non-governmental NFP. Restricted assets. Restricted assets are assets that are not available for current operating purposes. So they're not available for current operating purposes. They are therefore restricted. Donors limited their use to a long-term purpose like capital asset acquisition. In other words, where did the restriction come from? When they were donated to the not-for-profit organization, the donors had limited their use for some type of purpose. So the limitation came from the donor, as the donor was to give the asset to the organization and put some type of restriction, some type of limitation on it. Restricted assets should be classified separately from current assets on the face of the statement of financial position. So when we're considering the statement of financial position, similar to the balance sheet type of activity, we're looking at the assets section. We have the current assets. We're going to have the restricted assets that will have a separate categorization to give the implication or to show the restriction of those assets. Next, we have investments. Now, when we consider investments, there's a couple things that are common to the question of investments. How are we going to deal with investments? The investments are going to be a type of asset on the book, so we have an asset related to investments. The questions come into play as to how do we record the investment that we receive. Typically, if we purchase it, then obviously we record it at the purchase price. However, if it's a donated asset, say such as donated securities that were given to us, how do we value that? Because the person who purchased it at some point in the past, now is giving it to us. Do we put it on the books at the fair value or some other value? Also, there's always a question as to should we record the change in the value of investments. If we have securities that are actually traded on the stock exchange, they could go up and down, and we can know with fairly good certainty what the current value of that is, as opposed to something like equipment, where we don't know what the value, or a building, because they're unique in nature, and we only know what the value is once we sell it. With investments, they're more liquid in nature, and we have similar investments that are trading, and we have a pretty good idea of the valuation for investments. So the question always is, should we adjust the value of the investments to the market value, the current value at the reporting date, or should we be reporting it at basically cost, as a similar way that we would do for like property, plant, and equipment? So if there was a purchase of investment, the acquisition price for the debt securities or fair value for equity securities are typically going to be used. And that's going to be fairly straightforward. If we have a purchase for a not-for-profit organization of investments, if we took some of our cash and then purchased it, typically then you purchased it on the market, and we would be recording that investment at, in essence, the price that we purchased it for typically. If we have the donated investment, however, that's going to be the situation that's going to be a bit different in a not-for-profit organization, typically than a for-profit organization, where we will report it at the fair value on the date of donation. Again, note the scenario that can happen here. If we have some donor that gave investments like stocks, let's say, to the organization as opposed to cash, the question is, how do we record that? Because when they bought the stocks, their cost, their basis, in other words, happened way back when they purchased it. Now they're donating it to us. Do we take their cost that they paid for it, or do we take the current price at the time of donation? And the answer here is we're going to take the fair value at the date of the donation. If we have the reporting periods, such as the fiscal year end, so the fiscal year end, when we report the financial statements, how should we report the investments? Should we report the investments at the cost if we purchased it, or the fair value at the point in time that it was donated to us, or should we adjust it to the fair market value at the point in time of the date of the financial statements that we're putting together typically? And the answer here is we're going to be putting it at the fair value at the measured date, at the measurement date. So when we make the financial statements, in other words, we will typically be adjusting much of the investments. If it's a stock, if it's a publicly traded stock, we're going to say, hey, we know what the fair value is. We're going to make an adjustment to the market value, to the fair value at the point in time, in essence, that we are creating the financial statement. Well, then the question is, well, what do we do if you think about that logistically? How would we do that from a bookkeeping standpoint? Let's say that the investment went up in value. We know it went up in value because we looked at the stock exchange, and we know that the same stock is selling at a higher price. Therefore, we can safely assume that our stock is valued at that price at the date and point in time that the sales are made. at that time. So we're going to increase the value of the investment. Well, what do we do with the other side? We didn't sell it, right? We didn't sell it, and typically we don't record income until we sell something. So we're going to have to, how do we record the other side? Either we put it into like an equity section, or we put it into income in the current time period. And the answer here is we're going to have a realized and unrealized gain or loss. What are we going to do with the realized or unrealized? Reported on the current period's statement of activity. Now, realized gain simply means that we sold it. If we sold it, we realized the gain, and there's not much question there. If we sold the stock, we realized the gain. We're going to record the sale of the stock, and we're going to recognize the gain or loss on the sale. So we're going to debit cash, we're going to credit the stocks that were sold, and the gain or loss on the sale will then be recorded on the statement of activities, which is like the income statement. Now, if it's unrealized, then that's where usually the question comes in. What if it just went up in value? We didn't sell it. It just went up in value, and we're going to report it at the increased value. Well, we're still going to report that unrealized gain, which means we haven't sold it, but it went up in value on the statement of activity. Affects appropriate net asset account, net asset without donor restrictions, or net assets with donor restrictions. So when we think about the net asset accounts, remember that the income that we're going to report, the unrealized gain or the realized gain, is going to then be closed out in the closing process to what would be similar to the equity section, which we're going to call net assets. The net assets are going to either have restrictions on them or not to be restricted. Now, when we think about the investment income, it may have restrictions or it may not. It's really due to whether the donor had put restrictions on it or not. So in other words, the donor could have said, hey, here's some stocks, here's some investment, here's some stocks. I have no restrictions on it. You can do with it whatever you would like. There is a restriction to some degree in the function or the form of the asset that we get. For example, if we got a house or something like that, or a building, we're restricted to use it kind of like as a building. We could sell it and whatnot, but we're somewhat restricted. But that's not what we're talking about with restrictions here. Doesn't matter what the thing was given, the asset that was given. The restriction would be from the donor to say, I want you to use this in some specific way. So if they were to say, I want you to use this investments and the proceeds from it in some specific way, then there would be some type of restriction on it. If there was a restriction on it and the income was restricted, then when we close it out, it would be going out and closed out to the restricted, similar to the equity account, restricted net assets type of account. Footnotes. We also need detailed footnotes related to the investments.